Welcome everybody to our webinar case study today. I'm lucky enough to have Kevin Shrestha with us. Kevin, thanks for joining us.
Yeah, most welcome, Gianni. Good morning to everyone.
Very good. Good to hear. Good to have you with us, Kevin, and good to have you all with us. Again, if there are any questions, please don't hesitate to reach out via the Q&A function on the Teams meeting forum. In today's session, we're going to be going through this scenario, a case study scenario, how Kevin was able to save a couple more than $210,000 in home loan interest and $1,360 in income tax per annum. A word of warning before we do proceed, a bit of an advice disclaimer. This case study that we're going through is general in nature. It doesn't apply to any person's specific financial scenario. And that being said, you should take it with a grain of salt. Anything that we go through in this session is only general in nature, and I strongly consider that you speak to a financial advisor to understand if it's applicable to your personal financial situation as well. Before we move on, a little bit about Kevin. Kevin's a highly experienced financial planner with over 25 years in financial planning experience. His approach begins with taking time to truly understand a person's individual circumstances. His expertise spans a wide of financial areas, including superannuation, tax, investments, and retirement planning. So if you or somebody you know is looking for guidance to achieve their financial goals, I strongly suggest that you reach out to Kevin, and we'll provide his contact details at the conclusion of this webinar as well. So look, without any further ado, Kevin, I will let you take over from here. Please just let me know when you're ready to move on to the next slide.
Yeah, thank you, Gianni, and good morning to everyone, and especially if someone is attending this webinar from Queensland and Northern New South Wales. Hope you guys are keeping well. I know the weather, it's been a bit unpredictable, but hopefully all is good. Now, thank you for giving me the opportunity to speak to you guys and present a case study where we have been able to significantly add value to our clients. So a bit of a background about the clients. Now, at any time, if you have any questions, things like that, please put that through the chat line, or you can ask me at any time during the conversation. So just a bit of background on the clients. These clients came to us. So these clients, they are in their 46. So both of them are 46. Now, the husband, he's a tradesman and she's an accountant. They are married and they've got two adult kids. One is 18 and the other one is 19 years of age. Now, they're working both full time. He's earning 109,000 and she's earning 116,000. Now, they own their own home, which is valued at about 1.3 million, but they still have a significant amount of debt, which is about 835. And they have superannuation balance. He's got about 122,000 and she's got about 180,000. And in terms of other investments, the only other investments that these couple have is a cash account sitting in a bank account, with a balance of about 50,000. So just to give you a bit of a background in terms of what the client situation is, because it's very important to understand what the client situation is first, and then take it from there. So Jen, if you could just move to the next slide, please, mate. Okay. Now, as I said, this client came to us for some advice. And when we sat down with them, we go through our discovery process and we ask them, what's important to them, what they're trying to achieve. And then when we discussed that with these clients, they said a couple of things, these are the important things for them at this stage. The first one was they wanted to review their super, because as we all know, superannuation is a significant asset for a lot of our clients. So they wanted to review their super because they really haven't done much regarding their super. It's been the same super for a long time. So they just wanted to make sure that, because the value is increasing every year, they just wanted to make sure that they're in the right product, want to make sure that they have the right investment, all those sort of things. So that's important to them. And the second one is they wanted to review their debt management as well. And they wanted to pay the debt, which is about 835,000 as soon as possible. So they wanted a bit of advice on that as well. And the third thing was, as we all want to do, we want to reduce the income tax liability that we have to pay to the government. So, that was important to them as well. They said, Kevin, I want to look at if there is any way we could reduce our tax bill. So that's the other important consideration for them. And the third one is, because they've got a young family, they've got significant amount of debts, but they just wanted to make sure that they have adequate insurances or financial protection in place, touch wood, if something were to happen to them. So, when we sat down with them in our discovery meeting, so these are the four sort of important sort of goals for them at this stage? Just to recap, to review their super, to review their debt management, as they want to pay the debt, significant debt as soon as possible. And the third one is reduce the tax. And the fourth one is to have some insurances in place so that the family is protected, touch with something what happened to them. So these are the four objectives. Now, could you please move to the next slide, please, Yanni? Okay. Now, in terms of what, after we had the discussion, just to summarize, these are some of the recommendations that we made to our clients to achieve their goals. Now, the first one is, making salary sacrifice. As I pointed out, one of their goals is to reduce their income tax. Now, by making salary sacrifice contribution into super, the contribution gets taxed at a concessional tax rate of 15% compared to the marginal tax rate. So that's one way to reduce the tax bill. And the other thing is by having contribution made into super, it's concessionally taxed 15% versus the marginal tax rate, which is 32.5%. And not only that, when the money is sitting in super, the earnings are taxed at 15% compared to the marginal tax rate. Plus, by funding some of the insurances within their super, it becomes cost effective as well. So a couple of reasons why we recommended salary sacrifice is, as I said, to reduce the tax bill, plus a few other things as well. Now, I will show what the outcome out of that salary sacrifice recommendation is, but that's one way to reduce the tax, by making salary sacrifice contribution. And the other one was, as I said, they wanted to review their super because they hadn't reviewed their super for a long time. And it's very important to review that on an ongoing basis because things change. The product features change all the time. And for a lot of our clients, superannuation is a significant asset. So it's important that they review that. And what we did was by looking at the existing super, we were able to find an alternative product which was much more cost effective. It had better investment options, and we were able to, recommend investment options which is in line with their risk profile. So I will show you, what the outcome of this has been. They were able to save about $1,000 plus in fees, plus, they were able to have the appropriate investment in line with their risk profile. And even by saving that $1,000 a year over the next, 20 years or so, that's going to make a significant impact on their superannuation nest egg. Now, the third one was to review their personal insurances. Now, because they've got a young family, they've got significant amount of debt, we were able to recommend some insurances within their super. And, we recommended insurances like life insurance or term insurance, TPD and income protection as well, so that, touch with something would happen to either of them, the family is financially well protected, they don't have to look at selling the principal home or or other things. So very important to have appropriate level of insurances, and we were able to do that because at this stage they did not have anywhere near the amount that was required for their personal circumstances. So, we provided that sense of security, in case if something were to happen to either of them, that, the financial position would not be worse off. And the third one, or the fourth one, is to reduce the mortgage. I guess the amount of debt is quite significant. It's about 835,000. So what we did was, as I said, the 50,000 that they had was just sitting in the bank account. And then what we recommended was, of course, in consultation with the mortgage brokers, with you guys, we recommended that cash account should be linked as an offset account to his mortgage account, to their mortgage account, so that the interest payable is lower because of that offset account, and any savings that's made out of that salary sacrifice arrangement, that can also go into that offset account. And then I'll show you, just by having that 50,000 in an offset account instead of just sitting in a cash account, earning low interest and having to pay tax on that, they have been able to reduce their repayments, not repayments, they've been able to reduce the loan term quite significantly. And by doing that, they would have additional opportunity to expand or to borrow additional funds in future for other investment properties, things like that. So these are the four recommendations that we have made. And then I'll quickly go through, what the outcome of these strategies has been. Now, does anyone have any questions regarding the recommended strategies?
Uh, Kevin, I wanted to ask, how do you go about reviewing an investment profile in relation to the client specifically? What characteristics of the superannuation or their investments are you looking at?
Okay, so what we do, that's a nice question, Gianna. Thank you for that. So what we do is we know that every client is different. Every client has different level of risk profile. And then what we do is when we complete the fact find, we have what we call a risk profile questionnaire that we go through with each client, because we understand that each client have different, they want to take different level of risks depending on, what sort of time horizon they have, what is important to them to have capital growth or to have stability. So once we go through that risk profile questionnaire journey, we'll have a better understanding in terms of, what sort of risk profile is more appropriate to them. And generally, superannuation, due to preservation rules, for a lot of our clients, it is a long-term investment, especially, if you've got 20 years or so, that is a long-term investment. And history says that if you have time, you know, most people are comfortable to take that additional risk, because the whole idea of investing is to maximize the growth. And if you have time, history says that yes, it can be volatile at times, but usually the outcome tends to be better in the long run. So, we go through that risk profile questionnaire before we work out what sort of
Mm.
investment option is appropriate for each client, Gianni. Mm-hmm.
Yeah, nice. Well done. And what about investment preferences? Does anybody ever talk to you about investing in ethical or sustainable investments?
Yeah, we get that because there are so many investment options available nowadays. So yes, we go through our standard risk profile questionnaire, but yes, some people have preference about, now, I don't want to invest in anything to do with alcohol or with tobacco, things like that. So in that instance, yes, depending on, if there are investments available, and some fund managers, they do offer that ethical investments options as well. So if someone has a preference of that, we'll have a bit more detailed discussions with them in terms of, why they want to choose that investment option. And if that's what if if that's what they want to do, we can design a portfolio based on their needs as well, Gianni.
Yeah, nice. Well done. Next
Now,
slide.
sorry, you got anything? Yeah. So if you want to move to the next slide, please, Matt. Yeah. Okay. Now, this is the benefit of making salary sacrifice contribution. Now, as I said, the husband, he was on 109,000, so we recommended that he makes a contribution of 5,000 into his super. And by doing that, as you can see, that the total tax saved is about $850 just on making that 5,000 salary sacrifice contribution, because that 5,000 gets taxed at 15% when that goes into super, compared to his marginal tax rate. So that's the difference. And for her also, she's on a higher salary of 116,000, and we recommended her to make a salary sacrifice contribution of 3,000. And by doing that, similar analogy, she will be able to save about $510 in tax. So the combined savings in tax each year is about $1,360. Now that meets one of their goals, because one of their goals is to reduce their tax liability. So by making salary sacrifice contribution, besides few other benefits, they have been able to reduce their tax by about 1,360 combined a year. So that's the benefit of salary sacrifice. Now, you want to move to the next slide, please,
I
Gianni?
was going to ask Kevin,
Yes,
can
Gianni.
somebody just contribute as much as they like into superannuation, or what considerations do they need to take into account?
Okay, a good question, man. There are limits in terms of, how much a member can make contributions into super. So just on a high level, there are two types of contribution that can go into super. One is what we call before tax or concessional, or the other one is what we call after tax or non-concessional. Before tax contributions are contributions like the employer contribution, which is 11.5%. It's going to go up to 12% come 1 July. A salary sacrifice contribution like the one that we are recommending, or member tax deductible contributions. So these are what we call pre-tax or concessional contributions, and the limit there is 30,000. Okay. Now, if a member has a balance of less than 500,000, they can bring forward any unused concessional contribution from the previous financial year, but the balance has to be less than 500,000 as at the end of last financial year. So these are concessional contribution, that's the limit. And the after tax or the non-concessional, the limit is 120,000 a year, or 360,000 over a 3-year period. So these are the two types of contributions. Now, with before tax contribution, because it's before tax, that gets hit with 15% contributions tax. Whereas with after tax, there is no contributions tax, because that's from the after tax contribution. But the thing to keep in mind with super contribution is, doesn't matter whether it's before tax or after tax, there are preservation rules and condition of release. So once the money goes into super, it's preserved until you make a condition of release. So that's something everyone has to keep in mind. And the other thing is, when people, when clients are, Kevin, so I can put 30,000 salary sacrifice. Nah, that 30,000 includes your employer contribution as well. Okay. I get this asked all the time. Oh, okay, we're good. Then I can put 30,000 because I've just sold my investment property. I'm just looking at some tax minimization strategy, so I can put that in. That please make sure that that includes the employer contribution as well. But as I said, if the can balance is less than 500,000, if you have any unused concession contribution from the previous financial years, then you may be able to carry that forward. You may be able to use that. But yeah, make sure that you speak or you look at the contribution history before you do any of these things.
Yeah, for sure. And I'm sure there'd be like a break-even point as well when contributing to superannuation is no longer as efficient, and it's also dependent on a person's cash flow as well.
Absolutely.
Yeah. Okay, nice. Well done. Next slide.
Yes, please. Now, very important to review super on a regular basis. Now, like with these clients, they had not reviewed their super for a long time, and we find that that's very common with a lot of our clients. They think, oh, I started this, I was working as an intern or as a tradesman or whatever. I started this when I started my first job. Seems to be going well. I get annual statement every year, but a lot of things have changed in superannuation and in terms of product features, in terms of fees, in terms of investment options, all those sort of things. So we reviewed their investment, the superannuation product that they had, and by reviewing that, we were able to recommend a better alternative. And in doing that, they were able to save fees by about $1,000 a year. And not only that, we were able to align the investment recommendation in line with their risk profile as well. Okay, so by having these, by saving $1,000 a year, over the next 20 years or so, that's going to make a significant impact on the, overall superannuation position at retirement. And by having the appropriate investment option in line with their risk profile, in line with the risk appetite that they were prepared to take, they feel more comfortable and they understand that, yep, we are there for the long term. And yep, markets can go up and down, but they have much better understanding.
Yeah, because I'm sure that, with the additional contributions of, salary sacrifice and the $1,000 savings, that $1,000 might not seem like a lot, but compounding over the next sort of 15 to 20 years. Yeah.
Absolutely, yeah. As Einstein said, the eighth wonder of the world is the compound interest. So, as you say, $1,000 a year might not be that significant, but over the next 20 years, the fact because it's been compounding every year, so that'll have a significant impact. Absolutely. And with these clients, we review this on an ongoing basis as well, because someone has a certain particular investment profile today, in 10 years' time, that could be different. So that's why it's very important to review that on an ongoing basis. Uh, Next slide, please. Yeah. Now, insurance is very, very important. And in this instance, as I said, they did not have the appropriate level of cover, but by reviewing their situation, we were able to recommend the level of cover that was more appropriate to their needs. So we were able to recommend term life or the life insurance, TPD and income protection policy, and they were able to have that within their super. So usually if you have insurance within the super, it is usually tax deductible to the fund, so the premium gets to be a bit cheaper over the longer term. So very important to make sure that clients have appropriate level of cover, especially when you have that sort of significant amount of debt. So yeah, in this instance, we were able to recommend life cover, TPD, and income protection. Now, term life and TPD, it's a lump sum payment, whereas income protection, it protects a certain part of your income after a waiting period up to a certain age. So very important. Like sometimes clients, they insure their house, they insure their motor vehicle, but for a lot of clients, the most important asset is the ability to generate an income, and that's what income protection provides. Whereas the term life and the TPD, these are lump sum payments. And every time we have a review, yeah, we ensure that we go through the insurance needs as well, because a lot of clients do carry a significant amount of debts and they do have dependents as well. So very important to protect if something were to happen to either of the parties. The next slide, please. Now, just this projection in terms of what the outcome is, just by recommending having that 50,000 that is currently sitting in, that was sitting in the bank account, instead of sitting in a bank account, to have that as an offset account and link to your uh, mortgage account. So by doing that, our calculation shows that the clients were able to save nearly 5.5 years in terms of the time period to pay off their mortgage. And then this provides additional opportunity for mortgage brokers like us, like you guys, to unlock, and then get additional borrowing for other investment properties, things like that. But that's a significant savings to the client. And all we've done is just having that 50,000 sitting in the bank account, you know, put that as an offset account, and then link that to their mortgage. Yeah, so we can see that, yeah, nearly 5.5 years in repayment terms.
Yeah, awesome.
Yeah,
And we've seen interest rates come down recently as
yeah,
well. So there's a lot of talk around interest rates, but even that level of saving there is fairly significant.
yeah, absolutely. And if the interest rate, as you said, Jan, it's come down, so yeah, it'll be further as well. Yeah.
Moving along.
Yeah, I guess, yeah. So this
Mhm.
one, okay. Yeah, so
Yeah.
as you can see that, in this instance, we have been able to assist our clients in a number of fronts. So the first one was to reduce the tax, and the way we did that was to make salary sacrifice contribution. The second one was they wanted to review their existing super, so we were able to do that, reduce their fees, and especially, have the investments in line with their risk profile. And the third one was they wanted to have adequate insurances, or they wanted to have the appropriate level of protection. And by recommending life TPD and income protection, they were able to have the appropriate level of covers in place. And the fourth one was to review their existing mortgage and see if they can reduce it. So by having that offset account and by linking it to the mortgage account, they have been able to reduce their long term by nearly, I think it was 5.5 years.
Nice. Well done. So look, thank you very much, Kevin, for going through that case study with us. Really appreciate it. And now's a great opportunity to send any questions through for Kevin. We will have a couple of minutes available for Q&A. Apart from that, I'd love to hear from anybody if they had any questions or feedback on the session today. What we will be doing is we'll be sending through a copy of this webinar to you via email as well, and that way you can watch it again. Uh, Kevin, we do have a question. The
hmm
question is, what are the implications at claim time for insurances paid through super?
Okay, that's a very good question. I think it's Jason who asked that. Now, if it's inside super, it depends on who the beneficiary is. So let's start with the life insurance or the term insurance. Like if a term insurance is paid to a beneficiary who is a tax dependent, it's all tax free to the tax dependent. But if it's paid to someone who is not a tax dependent, then the lump sum payment could be taxed up to 17%, 17. I guess that's with the term insurance. Now with the TPD, TPD is paid to the member because it's not paid because TPD means totally and permanent disabled. So it's paid to the member, touching something what happened to the member, and the member is not able to work totally and permanently. Now, with that one, there are a couple of things. I don't want to make it too complex. Now, they get what we call an uplift factor. So depending on the younger they are, they get some tax-free components built in that TPD payment as well. But if you got a specific question, scenario, things like that, Jason, drop me a line. I'll be more than happy to explain how that works. But probably trying to explain that in a larger group, there are some calculations that we have to use, might be a bit complex. But yes, there are tax implications. But the younger the member is, a lot of that would potentially be tax-free to the member. Mhm.
Probably a good opportunity for you to discuss specifically in around those around that financial situation. So thanks for your question there, Jason.
Mhm.
Any other questions for us? Okay, we'll leave it one last moment for any questions. Otherwise, if there aren't any further questions, again, I want to thank Kevin for his time. Thank you very much, Kevin, for navigating through that case study with us. If
You're
anybody
most
would like to
welcome.
discuss more specifically their financial situation, or if they have a client, please don't hesitate to shoot that through to Kevin. Here are his contact details. You can reach him via email, you can reach him via mobile, or you can scan the QR code to book in a meeting directly and discuss your financial situation. Apart from that, we're right on time. So I really want to thank everybody for their attendance in this morning's session and hope to see you again at future case study webinars. Thanks again, everybody. Have a great day.